China, the economic giant that has been a driving force in global trade and growth for decades, now finds itself at a critical crossroads. In recent years, a series of massive negative changes in the Chinese economy have emerged, shaking the world and casting doubt on China's economic stability. Let's look at this in detail. Factor 1. Economic slowdown and trade disruptions. China's economic growth, once a marvel, has experienced a significant slowdown in recent years. In 2023, the country's GDP growth rate plummeted to 3.5%, the lowest in over 3 decades. This slowdown has been primarily attributed to declining domestic consumption and mounting debt levels. The ongoing trade dispute with the United States has added fuel to the fire. In 2022, China's total exports to the U.S. decreased by 8.4% compared to the previous year, totaling $543.9 billion. The imposition of tariffs and trade restrictions by both nations has disrupted global supply chains and affected industries worldwide. China's trade disruptions have had a significant impact on its economy. The ongoing trade dispute with the United States, characterized by tit-for-tat tariffs and trade restrictions, has resulted in reduced bilateral trade between the two countries. In 2022, China's total exports to the U.S. declined by 8.4% compared to the previous year, amounting to $543.9 billion. The trade tensions have disrupted global supply chains, affecting industries ranging from manufacturing and technology to agriculture and automotive. The trade disruptions have not been limited to the U.S.-China relationship alone. As China is a major player in global trade, any disruptions in its export-oriented economy have had a cascading effect on countries and businesses worldwide. Many nations heavily reliant on Chinese exports, such as Germany, Japan, and South Korea, have felt the impact of reduced demand from China. The economic slowdown in China and trade disruptions have also had consequences for commodity markets. China's demand for commodities, such as industrial metals, oil, and agricultural products, has historically been a significant driver of global commodity prices. As China's economic growth slowed and trade tensions persisted, the demand for commodities from China declined. This led to price fluctuations and volatility in global commodity markets, affecting commodity exporting countries and impacting global trade dynamics. Factor 2. Real estate risks and property bubble. One of the critical areas of concern in China's economy is the risks associated with the real estate sector, including the potential for a property bubble. The rapid expansion of the real estate market, fueled by easy credit, speculative investment, and urbanization, has raised questions about the sustainability and stability of the sector. 1. Soaring property prices. China has experienced significant increases in property prices, particularly in major cities and metropolitan areas. Skyrocketing housing prices have made homeownership increasingly unaffordable for many, especially young people and low-income individuals. The high demand for housing, fueled by speculative investment, has contributed to the rising property prices. 2. Excessive investment and overbuilding. The real estate boom has led to excessive investment in the construction and development of residential and commercial properties. The rapid pace of construction has resulted in oversupply and the creation of ghost cities, empty developments with little or no occupancy. Overbuilding poses risks to financial institutions and investors who have financed these projects, as well as potential social and economic consequences. 3. High levels of debt. The real estate sector's expansion has been fueled by massive borrowing, with developers, homebuyers, and local governments accumulating significant debt. This debt burden raises concerns about the ability of borrowers to service their loans, especially if property prices were to decline or interest rates were to rise. The exposure of financial institutions to the real estate sector amplifies the risks associated with high debt levels. 4. Financial system stability. The interconnectedness of the real estate sector with the broader financial system presents risks to financial stability. Real estate-related loans constitute a substantial portion of banks' balance sheets, making them vulnerable to any downturn in the property market. A sharp decline in property prices or a burst of the property bubble could lead to defaults, liquidity strains, and potential systemic repercussions. Factor 3. Debt crisis and financial vulnerabilities. China's rapid economic expansion was partly fueled by a surge in debt, both at the corporate and local government levels. As of 2023, China's total debt-to-GDP ratio has soared to a staggering 335%. This level of debt raises concerns about the country's financial stability and potential ripple effects on the global economy. In 2023, China's GDP growth rate plummeted to 3.5%, marking the lowest level in over 3 decades. China's economy has been grappling with a mounting debt crisis and increasing financial vulnerabilities, which have raised concerns about the sustainability of its economic model and the potential risks it poses to global financial stability. 1. Rising debt levels. China's debt levels have surged in recent years, fueled by extensive lending to support economic growth and infrastructure projects. As of 2023, China's total debt to GDP ratio stood at around 285%, one of the highest in the world. The rapid accumulation of debt has raised alarms among economists and policymakers, highlighting the potential risks associated with excessive leverage. 2. Corporate debt. A significant portion of China's debt burden comes from corporate debt. State-owned enterprises and privately owned firms have taken on substantial levels of debt to fund expansion, investments, and infrastructure projects. The debt levels of some highly indebted sectors, such as real estate and construction, have become a major concern. The risk of defaults and liquidity strains within the corporate sector has implications for both domestic and international investors. 3. Local government debt. Another key aspect of China's debt crisis is the mounting debt of local governments. In the past, local governments relied heavily on off-budget financing through local government financing vehicles to fund infrastructure projects and stimulate economic growth. This practice has resulted in a significant accumulation of debt, with estimates suggesting that local government debt in China reached around 100% of GDP. Factor 4. Banking sector stress and shadow banking. China's banking sector has been under increasing stress, with rising concerns over non-performing loans or NPLs and the proliferation of shadow banking activities. These issues pose significant risks to financial stability and have far-reaching implications for the Chinese economy and global financial markets. In 2023, China's NPL ratio reached 4.9%, the highest level since the global financial crisis in 2008. This increase in bad loans highlights the deteriorating quality of assets held by Chinese banks, potentially impacting their ability to support economic growth. Additionally, China's shadow banking system, which includes non-bank financial intermediaries, poses systemic risks. The rapid expansion of shadow banking activities has amplified concerns about regulatory oversight and potential defaults, leading to financial instability. The expansion of shadow banking in China has raised concerns about financial stability and systemic risks. The lack of transparency and regulatory oversight associated with shadow banking activities can lead to potential defaults and contagion effects within the financial system. Chinese authorities have taken steps to rein in shadow banking by tightening regulations and increasing supervision. However, the complex nature of shadow banking makes it a challenging issue to fully address. The risks associated with the banking sector stress and shadow banking activities in China extend beyond its borders. Given China's prominence in the global financial system, any disruptions or instability in its banking sector can have spillover effects on international markets. The interconnectedness of global financial institutions means that problems within China's banking system can quickly spread to other parts of the world, amplifying financial volatility and risk. To mitigate these risks, international cooperation and coordination are crucial. Close monitoring of Chinese banks' health and the effectiveness of regulatory measures is necessary to ensure the stability of the global financial system. International institutions, such as the International Monetary Fund or IMF and the Financial Stability Board, play a crucial role in promoting financial stability and facilitating dialogue between China and other nations. Factor 5. Demographic challenges and technological competition. China's aging population presents a formidable challenge to its economic prospects. The working-age population has been shrinking, and in 2023, the number of people aged 15 to 59 fell by 4.7 million, marking the 9th consecutive year of decline. This demographic shift puts pressure on labor supply, pension systems, and economic productivity. Furthermore, China faces fierce competition in advanced technologies and innovation. With the rise of countries like the United States, South Korea, and Japan, China's position as a global tech leader has been threatened. Technological decoupling efforts, coupled with intellectual property concerns, have hindered China's ability to maintain its technological edge and led to a loss of investor confidence. Factor 6. Global ramifications. The negative changes in China's economy have reverberated throughout the world, creating significant global ramifications. Global stock markets experienced heightened volatility as uncertainty surrounding China's economic future grew. Commodity prices, particularly those tied to China's demand, were affected, leading to fluctuations in the global commodity market. For instance, the prices of industrial metals like copper and iron ore experienced sharp declines due to reduced Chinese demand. The slowdown in China's economy also impacted emerging markets heavily reliant on Chinese investment and trade. Countries like Australia, Brazil, and South Africa, which export raw materials to China, saw their economies hit hard as demand waned. In addition, multinational companies with significant operations or supply chains in China faced disruptions, affecting global manufacturing and trade flows. The Chinese yuan's devaluation amidst the economic crisis added further complexities to the global financial landscape. Currency fluctuations created uncertainties for international investors, causing capital outflows from emerging markets and potentially triggering currency wars and trade imbalances. Furthermore, the implications of China's economic crisis extended to international institutions and organizations. The International Monetary Fund, World Bank, and other global financial institutions had to reassess their growth projections and recalibrate strategies to mitigate potential risks stemming from China's economic turmoil. Governments around the world closely monitored the situation in China, as the country's economic health has become intrinsically linked to the global economic order. Efforts to stabilize China's economy through fiscal stimulus packages, regulatory reforms, and monetary policy adjustments were closely observed, as any missteps could amplify the negative repercussions for the global economy. Conclusion: China's economic crisis, marked by a significant slowdown, trade disruptions, mounting debt, real estate bubble risks, and demographic challenges, has sent shockwaves throughout the world. The global ramifications of China's economic challenges have been evident in volatile markets, disrupted supply chains, and weakened investor confidence. As China grapples with these issues, international cooperation and collaboration become vital in navigating the uncertain economic landscape. The path to recovery for China will require structural reforms, addressing financial vulnerabilities, and fostering innovation to reignite economic growth. The world watches with anticipation as China's economic fate unfolds, recognizing that the resolution of this crisis will have far-reaching implications for global economic stability, trade dynamics, and the balance of power in the post-pandemic era.